Hey, Eric here from 5minuteinvesting.com, and today we're going to talk about how to manage your own portfolio, why you should or should not manage your own portfolio, what does it mean to manage your own portfolio, and what should you expect when you are managing your own portfolio. So let's talk about what does it mean to manage your own portfolio. When you are trying to manage your own portfolio, you're actually doing a lot of things. You're picking a company that you believe, that you like, you trust, or you did your research on. You're picking a time in which you enter. You're picking how much you enter, which is portfolio allocation. And you can also pick when to exit. So when you think about it, you're actually trying to be a fund manager yourself, and you're making a lot of decisions. So if you put in so much work, should you even do it? And I think that is a great question. Whether you should manage your own portfolio, because there are situations where you should manage your own portfolio and there are situations where you should not manage your own portfolio. And I think to answer that question, you first need to look at what the average is. What happens if you don't manage your own portfolio? Then chances are you're going to buy an ETF fund, an index fund, or a mutual fund. Now, when you invest in the market using an ETF fund, chances are you're going to get that market return. So if you go Google the average return of S&P 500 for the last 30 years or so, you're going to get 7% on average. So you can actually easily search that up. It's around 7% across 30 years. And most people don't actually get that return, because when you invest in an ETF fund or a mutual fund, they're going to take a transaction cost or a management fee of 1 to 2%. Now 2% is considered to be high, and 1% is average. And if you invest in an ETF fund, then the management costs might be around 0.5. So that is the lowest I've seen so far. I think sometimes you might see a lower, like a 0.25 as well. So this is a pure 100% stock return. But if you invest, for example, in bonds, like the mutual fund invests in 50% bonds and 50% stock, then this return will be lower. So chances are you're expecting somewhere between 3% to 6%. And if the market is good, then you might be 7 to 8%. But that should pretty much be where everyone is. Now, if you are managing your own portfolio and you put in all this work, you spend hours researching a company, trying to understand, trying to get a higher return, and all you're getting is 8 to 9%, you really want to evaluate whether that is worth it, because you're only getting an incremental return, and you can better focus your energy elsewhere and just hire a mutual fund manager to do it for you. So that is when you should not manage your own portfolio, because the return you're getting is really not significant enough to justify all the work you're putting in. Because I know people that spend 3 to 4 hours every night looking at the stock market, trying to pick the next stock, trying to monitor the markets, day trading, short-term trading, swing trading, or whatnot. And that's actually quite time consuming. And in the end, the return they're aiming for is like 8 to 9%, maybe 10%. So if you are aiming too low, then suddenly it's not really worth it to manage your own portfolio anymore. So if you are managing your own portfolio, then what should you aim for? Now, this is a very judgmental question, and for myself, I aim for around 30%. Now, why is that? When you look at the market, there's public, stocks that people just buy on the stock market, like Starbucks, Walmart, or whatnot. And there's also the private companies where private equity funds invest in. And they use special investing strategies that are not common to the average investor. And they aim for somewhere between 20% return to 50% return. So here I wrote down 30% on average. So that's what I aim for as well. And I'm going to explain the strategy for private equity in a little bit. But essentially, the return private equity funds are aiming for is much higher than S&P 500. Now, if you go Google what is the average U.S. private equity return versus S&P 500, which is the index fund, you're going to see that there is like a large separation over time, because private equity has more it has different investing strategies, and it has a different investing philosophy, and the time horizon for private equity funds are usually longer, so that leads to a higher return. So what difference does it really make? You're making 4 to 6% here versus 30% for private equity. Now, it really comes down to how fast you can retire and how much money you're going to retire with, which is just a speed and money problem. So here I did some quick math, and using compound interest, if you start with $10,000 and if you just put your money in an average index fund that makes around 5% a year, then in 10 years you're going to get 16K. So that means you have a growth of 6K, which is around 60%, which is not bad across 10 years. And this includes compound interest. But if you are a private equity investor, so you are accredited, you have a net worth of over $1 million, you have at least 100K to invest in one fund, then you're looking at a much higher result, which is 30% a year, and you would expect 107K at the end of 10 years. So you can see this jump. It's actually quite significant. And this is, in my opinion, the key separation between why the rich is getting richer versus the average investor is staying average. It's because of the return they're getting and the return they're aiming for. So what makes private equity funds or VC funds or startup funds so special? Now, this topic can go on for quite a few hours, but I'll summarize their strategy into 2 simple elements that I'm going to cover in this video. Now, the first element, it's called focus investing. I think around 10-20 years ago, there's a famous economic theory called diversification. And if you diversify, you don't put all your money in one basket, you kind of separate it out into multiple baskets, you try to invest in the market, so then you reduce the fluctuation in your portfolio, then you would be good. But when you look at private equity funds, they actually do quite the opposite. Because what they're buying is so large and expensive, like in millions of dollars, they actually need to focus and only buy private companies that are fantastic. They're great companies that are growing. So they adopt a philosophy of focus investing. So instead of investing in many little investments, instead of investing trying to get a piece of every company in the entire market, they just buy 100% of a few really big companies. That's actually what they do. And it's called focus investing. And if you study Warren Buffett or you read a few books on how Warren Buffett invests, he actually puts most of his money in the top 10 stocks of his portfolio. So Warren Buffett has around 50 stocks in his portfolio last time I checked. And if you just calculate the fair market value, the value of the top 10 stocks of Warren Buffett's portfolio, it's around 80 to 90% of his portfolio. And those are the key money drivers, the key income earners of Warren Buffett's portfolio. And private equity funds actually has a similar approach. Now, the second thing that private equity funds do, but Warren Buffett does not, is really leverage. Now, in private equity funds, there are a lot of different investing strategies, and one of them is to use leverage, which is debt, to buy a company. Now, most of the time when you're investing in an index fund or whatnot, you're not going to be able to use leverage, and the fund itself wouldn't use leverage as well. So you're really limiting to using your own capital to invest in the market. When private equity funds invest in a company, they borrow money from the bank, so then they're only using a very small portion of their own money to invest in the company, so that they maximize their return. And leverage is really a profit multiplier. And if you know how to use leverage well, then your return goes up. And if you don't know how to use leverage well, then it actually becomes a double-edged sword. So that's why when I aim to get 30% in the market, I do these 2 things, which is focus investing and leverage. And my investing approach is called long-term investing using stock options. And the pillars, the two pillars of the strategy is actually focus investing and leverage. So if you are trying to manage your own portfolio, I would suggest you to aim higher. You want to learn from private equity funds how they invest in the markets because the return is so much higher, and you want to dream bigger because that really impacts how fast you can retire. And if you are really just getting 5, 6, 7% and you want to manage your portfolio and you're spending 10, 20 hours on it every week, then I would recommend you to just go for a mutual fund, and you can spend your time elsewhere. For example, like start a new business or pursue your hobby or spend some time with your family, because the incremental benefit you're getting for managing your portfolio is really not justifying the cost. So that's it for this video. If you like it, you can click share, or you can leave a comment below to let me know if you have any other questions as well.